There's a lot of ways to be successful in the investing business, but most people are running funds. I think very few people are building firms. And a core distinction between funds and firms is that most fund managers are focused through a fairly narrow lens of like, what is my next marginal investment going to be? Most firms are run by entrepreneurs. But importantly, one of the unique competitive advantages, which we can get into more deeply, is
David Haber is a general partner at Andreessen Horowitz, one of the largest and most influential venture capital firms in the world.
And today he's revealing the key differences between funds and firms
and what it really takes to build an investment firm that lasts.
The objective function of a fund is sort of singular. It's how do I generate the most carry with the fewest people in the shortest amount of time possible. But these are things tactically that can make or break a company. Most funds, they often have a single CIO. It's the alpha kind of investment decision maker that, they have a bunch of other people that work at the firm, but ultimately it bubbles up to one person making a decision. But I think it's very fragile. If that person decides to retire, the entire infrastructure disappears almost overnight. But as a firm, there's actually very little top-down direction, right? Everything we do should ultimately reinforce delivering the best product for the entrepreneur. Entrepreneurs spend all their time thinking about their competitive advantages. And most fund managers, I would argue, don't. And so if you want to grow, making the firm feel like a platform for smart entrepreneurial people to build on top of is one of the most important reasons the firm, I think, is going to be so enduring. We are compounding our reputation first and foremost, but it's only because we're delivering a great product for the best entrepreneurs. And a firm, is really two variables. One is
David, it's so good to have you here. We actually first got connected about 5 years ago. I cold emailed you, cold DM'd you on X in your first week of joining Andreessen. So this is the first time we're speaking face to face. So it's awesome to have you here.
Ollie, great to see you, and thanks for having me.
There's this whole new trend emerging, which is, the fund versus firm kind of theme. What does that look like for the future of venture? You had a great article which just came out, which went super viral. So that's going to be the main theme of today's show. And there's this one big thing that everybody's talking about, AI. So hopefully get some hot takes from you around that. When founders think about fundraising, the one name which always comes up is Andreessen. But I don't think many founders actually know what goes on behind the scenes. How does Andreessen actually operate? I kind of think of it as you all run your mini little funds. Is that kind of how it works? What goes on behind closed doors?
It is. We're kind of a team of specialists, and the firm has grown. I joined the firm almost 5 years ago in 2021 to kind of do two things. One was to open our New York office, which is where I'm sitting, and we've grown our presence here, pretty meaningfully. We're now about 100 full-time people in New York City. The whole firm, by the way, has grown from about, I think it was 170 people when I joined in 2021, now about 600 people. Again, spread out across kind of all of our different investment practice areas. But importantly, one of the kind of unique competitive advantages, which we can get into more deeply, is the vast majority of our headcount sits across our operating platform, across a number of kind of functional areas, whether it's marketing or people practices or capital markets. It's this entire sort of war machine, that we make available to our entrepreneurs to kind of tilt the board in their favor. And that was sort of the core ethos, of Andreessen Horowitz from inception was, Marc and Ben, wanted to build ultimately the best product for entrepreneurs. I think their view, having been customers, of the best, venture capital firms at the time, was that it was a great product for LPs and kind of a mediocre product for the entrepreneur. And from the very beginning, they basically, instead of paying themselves, large salaries, they began sort of reinvesting management fees into this sort of platform. And that's just continued to grow and certainly benefited, from economies of scale. But from an investing perspective, we each sit across kind of our different, areas of expertise. Again, I sit in our AI applications fund, so investing at the early stages across, consumer and B2B applications. I tend to focus more on the B2B side of that equation. But, I often say we're strongest at our intersections. And so we collaborate, across the firm, fairly regularly as well.
It's amazing, just how fast Andreessen has grown. You just mentioned the headcount, which has grown massively, but also all the new initiatives you're launching, right? New media, which has just come out last night, some of the biggest creators, which we'll talk more about. But it feels also, venture is changing so quickly, but also the startup ecosystem is changing so quickly, right? AI, like ChatGPT came out basically 1,000 days ago. right? November the 30th, 2022, like I remember exactly what I was doing and this new thing kind of exploded. Have you been surprised just like how quickly AI has changed in really only 1,000 days?
Honestly, yes. I mean, it's grown, faster than I think we expected, and we were incredibly bullish, right? We put a lot of money to work, obviously, across, all parts of the AI stack, and it's exceeded our expectations. And, I think that's fundamentally because software is actually doing the work, right? And in so many markets, which I'm sure we'll get into, that were never particularly interesting to sell software into have now become radically interesting, spaces for investment because, again, the TAM is no longer just IT spend, it's actually labor. And I think that's one of the kind of core driving forces of kind of the acceleration that we've seen across many of our businesses. But yeah, it's been an incredibly exciting period. And candidly, I think we're still just at the beginning of this wave.
It's so exciting. And so many founders now are building amazing products with, 1-2-man team, right? And it's only going to keep changing. But how has your role as an investor changed? And now, where you spending most of your time, we're going to talk about some of the trends you're really excited about, but kind of just on a day-to-day, where are you spending most of your time? What's getting you really excited?
Yeah, look, we still spend the vast majority of our time meeting with entrepreneurs and trying to understand kind of what's happening on the frontier. And that's, an incredibly privileged position, right? We get paid to learn from, some of the smartest and most passionate people in the world about, their areas of expertise and whatever they're building. So, that's still the vast majority of our time. We also all spend a meaningful amount of our time, helping our entrepreneurs, build the best businesses we can. Part of that is sort of marshaling the resources of the firm, as I mentioned, the operating platform and ensuring that we're solving whatever problems come up. A big part of that is sort of building networks, right? Networks with the ecosystem of incumbents, right? And that's been a particularly fun thing to invest in and focus on here in New York City because, basically every large company in the world, has some meaningful presence in New York. And so, part of this was a bit informed by my experience at Goldman Sachs and just seeing, how distant in some ways, large incumbent can be from what's happening, on the frontier at the seed and Series A stage. And I think we have sort of a unique opportunity, as A16Z to be sort of this convening power, right? And so we spent a lot of time meeting, the CEOs, the executive leaders, the P&L owners at many of these companies who are driving, change and managing large organizations. They'd love to know what's happening on the frontier, but they have, other priorities. They have 10,000 people to manage. And so, that's part of what we're trying to do too, is understand their strategic priorities and then bring them, portfolio companies that are relevant in helping potentially solve those challenges. And by the way, some of those live within the portfolio, many of those don't. And so we just try to be sort of a clearinghouse for great ideas and great problems. And so that's been, another fun way to kind of spend time, especially here in New York City, although we do it, across the country and the globe as well.
I love that. We can talk more about like what the future of venture is looking like, especially with the whole value add distribution and moats and so on. So much we can cover there. But let's talk about your founding story. You mentioned Goldman Sachs. You actually, were a former founder, right? Building Bond Street. Like I actually remember when you guys started, I think it was around 2013, 2014. I saw this, lending business cover and I thought, oh, this is really cool. Let's check it out. Why do you want to go down this crazy route of like, building your own company?
Yeah, my career has kind of been bouncing back and forth in some ways between being an investor and an entrepreneur, and an operator, I guess, troublemaker maybe inside of Goldman Sachs. And I first kind of got exposed to, both technology and fintech in particular when I was at Spark. I joined them back in 2011. Got lucky in some ways, seeded amazing companies like Plaid when I was there. But as a young VC, would often bump into fast-growing physical products businesses, services companies that in many cases were doing, millions of dollars a year in revenue, were profitable, were growing, weren't necessarily a fit for venture capital, but also were struggling to raise bank financing. And as you dug into the problem, more deeply, you realized, taking out a loan from a bank really hadn't changed in 50 years, right? You still had to print out your physical financials, walk into a branch, they'd fax that document to Texas. Somebody's rekeying the information into their system. And, maybe 8 to 12 weeks later, you get a decision, yes or no. They're declining the vast majority of applicants. And you have no visibility, in that interim period as to the likelihood of approval or how much. It just seemed like a very broken process. And in 2013, as you mentioned, a lot was changing from a technology perspective. A lot of the data that we thought we would need to sort of understand the financial health of small businesses at that point was just becoming available online via API. So that year, Intuit just launched the QuickBooks API, but also Xero and Stripe and Harvest and Braintree. Many of the leading kind of accounting, invoicing, and payments companies were just beginning to kind of open up and become platforms. That year, the IRS started accepting e-signature, so you could get access to a company's tax transcripts programmatically. We knew we could write integrations into the credit bureaus. And as I mentioned, we had just seeded Plaid in 2013 as well. So you could authenticate access to your bank account and get kind of real-time visibility into transaction data. And so the sort of why now, at least from a technology perspective, seemed to really be changing in that moment where, again, instead of printing out your financials, you could kind of authenticate access to all your different accounts. We could ingest that information, and interpret the financial health of your company, and ultimately make lending decisions, in minutes instead of, days or weeks. And that was sort of the brand promise that we were trying to deliver with Bond Street. And, I think we did get close to that. It was a challenging business for other reasons, which we can get into, but I'm still very close with many of the entrepreneurs that we served. And it's just very gratifying to see the physical impact, that we've had, across the country and even here in New York City.
That's amazing. I mean, I kind of remember that time, 2014, 2018, 2014. Okay, I was only 16, 17 years old, right? Not to put an age on you, but that kind of whole time, 2014, 2018, like all of these neobanks were coming out. You can get a digital bank like super quickly instead of going through like, your mom and dad's bank, which took months and months to sort out. But I also imagine like back then, there were so many challenges like trying to get these fintechs kind of off the ground. What do you think were some of those early challenges, the top kind of like one or two, which are ingrained in you that you now pass over to, fellow fintech founders, which you had to overcome?
Well, everything was new, for me. I was a first-time founder. I was 25 when I started the business, at the time. So, raising equity was new, although I had some pattern recognition, I guess, from my time at Spark. Had never raised debt capital before, which is way more complicated and challenging than raising equity, because ultimately, you're sort of defining the perimeter of a box that your business model needs to fit comfortably inside. And VCs are, in my experience, are friendlier than credit investors who are very focused on downside risk versus sort of, potential upside. We ended up raising $900 million in debt capital, in the 4 years that we ran the business, $11.5 million of equity. So that was challenging. We were only able to do that because we built an exceptional team, which is what I'm most proud of. The first person that we hired was a guy named Jerry Weiss, who, I think was 57 when he joined us in my apartment building before we had payroll set up. He had been the former head of credit risk at Citibank, and at that point had been underwriting small business loans longer than I'd been alive, and really kind of set the culture of the company. Right, I think what he brought, he didn't just show up and said, you kids, you don't know what the hell you're doing. Like I'm the guy who's going to teach you everything. I think he understood certainly the value that he was going to bring to the business, but I think he also was excited to both learn from us and from the experience of going 0 to 1, which he'd never done before. And so that sort of set this tone of what I called like humble confidence, and that was sort of a quality that we looked for, in every person that we brought into the team. But there were a lot of challenges. I mean, even just a lot of the infrastructure that now exists in the fintech ecosystem, some of which we've invested in, here at Andreessen over the years, just didn't exist. So you had to build a lot of your own kind of internal, capabilities. You didn't get to sort of stand on the shoulders of other giants. And that just made it, more challenging than it, would be to build the same business, today, certainly.
I mean, that's the great thing about building a company, right? Yes, it's super exciting, but there are so many challenges that come with it. But one of the great things about the story is, this amazing giant came along, Goldman Sachs, right? And the product company was eventually acquired and it eventually became Marcus, which many of us know about. How did that all come about? And, what were you going through during those times?
Well, like with everything, I think it all starts with relationships. I mean, it's sort of funny. And I always say careers are long and you never know how life is going to reintersect. So I first met a guy named Omer Ismail when he was a managing director inside of the merchant bank in Goldman Sachs in 2014. And I met him because as I mentioned, I was trying to raise debt capital. I had no idea what the hell I was doing. I didn't know what the merchant bank did or what it was. I just thought it was sort of house money inside of Goldman Sachs. Turns out it's the private equity arm, basically of Goldman Sachs. And he, at the time, had been largely a private equity investor, but was working with firm leadership at the time to figure out what they were going to do with the bank. Goldman became a bank holding company in the financial crisis, and they always sort of treated the actual legal bank entity as sort of this sort of regulatory piece of infrastructure, because historically for 140 years, Goldman had been a broker-dealer, not really like a traditional bank in that sense. And yet they thought that there would be sort of an interesting commercial opportunity. And so at the time, he had actually expressed interest in potentially acquiring Bond Street then. We were 6 people working in my apartment. I'm like, what are you talking about? I just quit my job as a VC. I want to go be an entrepreneur. I don't want to go work at Goldman Sachs. Fast forward, 3 years later, we stayed close. We would get coffee every, few months. He, that sort of seed of an idea, ultimately became, a consumer business that he ended up leaving the merchant bank to go lead. And not everything in building a business is up and to the right. Lending Club had gone public in 2016 and then declined, precipitously in I think late 2016, 2017, almost 90%. And, we were trying to figure out, what to do with the company, right? Should we go, take the term sheet that we had for a Series B or, explore some of these, this M&A interest? And, ultimately we decided on the latter and, joined Marcus. About 30 of us joined Marcus together. And it was a fascinating experience, right? Going from, a team of a few dozen to 40,000 people overnight was, something I had never experienced before. Very much not the CEO of Goldman Sachs. But, I learned a ton about myself, about what leadership looks like, about, how a firm like that, truly operates, from the inside. We can get into that. But, in retrospect, I'm very grateful for that time and for the outcome that we had.
I was going to say, going from just a bunch of you, right, into this ginormous, conglomerate bank with tens of thousands of people all around the world, how did you mentally adapt going from that kind of, true founder mindset, hustling, grinding every day, to being in this kind of corporate wagon wheel?
I mean, honestly, the first 6 months was probably just recovery. I was exhausted. When you're building a business, you're 120% in. You're just sort of maniacally focused on building your company. There's a bit of a emotional disconnect that you need to kind of go through, I think, to make your team successful inside that organization, right? For the prior 4 years, they would look to you as CEO for kind of leadership and direction. And that wasn't the case, right? Many of them began reporting to other people in the organization. And you kind of have to let them go, right? And let them kind of assimilate into the company to be successful. So that was, I think, a bit of a transition. At some point, though, my natural instinct starts to lean into risk, right, as an entrepreneur. And I remember asking myself, what does it mean to take risk inside of a big company? And, for me, that basically meant completely disregard your title, your job description, speak very plainly to the most senior people at the company, and the most junior on what you see that's working and what's broken. And so I just started, funny enough, sort of sending cold emails, throughout the organization. I remember emailing, Marty Chavez when he was the CFO of the firm, Dan Dees when he was still the head of investment banking, Renan Agus, who was running, the alternatives business and the asset management division, and basically running around the firm and kind of mapping the place, and just basically showing up and saying hey, I'm here, I'd love to be helpful. And I think what's just so unique about, Goldman Sachs versus many other large companies is it's not an operating business that has, an American Express that has a consumer business and a commercial business and a network. It's really sort of this confederation of lots of small businesses, kind of fighting for collective resources under these common, divisional umbrellas. But because of that, if there's something interesting to do on the outside, there's somewhere to put it, right? Likely. You can be an equity investor, a debt investor, an acquirer, a customer, an advisor. And so a lot of, how I sort of viewed or eventually shaped my role was to try to be a bridge in some ways between Goldman Sachs and the outside world, and in large part to the technology world. And, I ended up meeting a woman named Stephanie Cohen, who had just been promoted to be the chief strategy officer. And we ultimately became, good friends. And then she asked me to come work for her and kind of write a job description. And so, while I was kind of running around on, on my own accord, I then had kind of air cover to do that, in her organization in firm-wide strategy.
I love that. When founders kind of go through that process, like you kind of mentioned, there's a disconnect, but also there's that kind of emotional roller coaster, right? When you were going through those, 4 to 6 months of just like recovery, and founders who are listening to this show, some of them might be going through something similar. What are those, 1 to 2 things you kind of did just to kind of like get back the David who David used to be before kind of like founding a company?
Honestly, reading a lot. I remember we moved, for folks that know New York City, we moved from Chelsea to the Upper West Side. And so, I would have, call it a 30-minute, subway ride, from the Upper West Side down to Battery Park. And I would just rip through, audiobooks or physical books on those commutes. I'd had, call it an hour a day. And I'd read probably a book a week, for those few months. And I remember feeling my brain physically expand, right? Because you just have headspace now for other things to think about as opposed to sort of just your company. Maybe I should have, read more, when I was, running Bond Street, but just sort of tapping back into that intellectual curiosity, I think was just very refreshing. Just part of the transition is just, again, approaching kind of this new experience with curiosity. I remember reading this book called The Partnership, partially because I was curious about the culture of Goldman Sachs, and it basically chronicles, the 150-year history of the firm. And Goldman, was and still is largely like one of the most entrepreneurial firms in the world, right? It wasn't like many of its peers, like J.P. Morgan and others. It wasn't a bank built through a series of bank acquisitions. It was a business built, brick by brick by generations of entrepreneurial partners sort of raising their hand and going off and building Europe or building, the merchant banking division or building the wealth management division. Many of these business units became kind of global franchises. And that was kind of an inspiring history. And so, again, reorienting. I think many founders go through an M&A process and they feel like they're sort of resting, investing, or frustrated inside of this new, company with a lot of bureaucracy. By the way, some of those things are true, but I think if you can kind of reorient and approach that experience with curiosity, you're going to learn a lot of new things. And again, I think with some distance from that experience, I've learned a tremendous amount, again, about what leadership looks like. How do you get shit done in a big company? What are they uniquely good at? What are they bad at? Where would you want to compete with them or not? What gets them to acquire a company for a lot of money versus a nominal amount? Like all of these have been actually incredibly informative, to even how I spend my time now, here at A16Z. And I'm very grateful for those few years.
One of the greatest things I think founders should also look for is when they're looking to fundraise, kind of like bringing this whole story full circle, is if they can find investors who have had an operating background and experience, as well as someone who's been a founder, I think that actually makes an incredible partnership. So kind of flipping back the question, how did this incredible opportunity come about from being a founder, joining Goldman, to then joining Andreessen?
Well, it kind of goes back to like, what I said earlier about, life re-intersecting. I ultimately, the credit is with Alex Rampell, who's been a longtime partner here at Andreessen. He was the one who ultimately recruited me to the firm. But I first met Alex, through a few different ways. One, he had led a later round in Plaid. We had seeded the company in 2013, and he ultimately invested, here at A16Z. Our eventual COO at Bond Street was a guy named Eddie Serrell, who used to work for Alex at his prior company, TrialPay. And he's an amazing entrepreneur and operator. He now helps lead the New York office at Stripe. So I think I got connected to Alex originally, through Eddie. I pitched Alex in 2015, 2016. He passed. We stayed friends. And when I was at Goldman, I helped them invest about $60 million into Carta, alongside Meritech, and then alongside, Andreessen. And on the other side of that deal was Alex and Marc. And then in COVID, when the world shut down, I was very afraid that small business owners weren't going to have access to working capital, and many of them only have about a month of buffer, and so they were going to go out of business. And we at the time, as a bank, could basically had unlimited leverage because we could pledge these assets to the Fed window. And so I was trying to find creative ways to plug Goldman's $1 trillion balance sheet into the economy. And because many banks didn't have online loan applications, I thought fintech would be a really important kind of distribution engine, for that capital. And so he and I were sort of jamming, in that vein at the time, kind of mid-COVID. And then over a long period of time, just as kind of friends on the internet, we would riff on this sort of subject of firm versus fund. While I wrote the piece only recently, I've actually been tweeting about this since I think 2016, 2017. And, I always viewed sort of A16Z as the archetype of what that meant. And it's something he's quite passionate about as well. And so, ultimately, he ended up reaching out to me in early 2021 and, basically precipitated the process, asked me if he could connect me with Marc Andreessen. And so I've never met Marc, of course. And, we kind of hit it off. And, Marc and he ended up coming out to New York. I ended up flying out to the West Coast and spending time with Ben, and actually went to a GP offsite and met the whole team, and, kind of snowballed from there. And, ultimately joined again in July of 2021 to really plant the flag here in New York City. And, it's been a lot of fun to help, kind of build the firm, at least in the city that I've grown up in professionally.
And for our audience who don't know who you are, you should definitely go and follow David on X. He's always, posting really cool posts around kind of this whole new generation of what venture may look like kind of going forward, the fund versus firm. Let's talk about that, because it's something I'm really interested in as well, especially how we look around, what does the future of venture look like? This whole fund versus firm, help us dissect what you're currently thinking, and we can jam on it.
Totally. Look, I should caveat this with, there's a lot of ways to be successful in the investing business. But I started thinking about this distinction because ultimately I feel best somewhere between being an investor and an entrepreneur, right? And this distinction of wanting to help build a firm as opposed to run a fund was sort of my articulation of that sort of experience. And the idea is that, the objective function of a fund is sort of singular. How do I generate the most carry with the fewest people in the shortest amount of time possible? And through that lens, most people are running funds. I think very few people are building firms. And a firm, is really two variables. One is, how do I generate exceptional returns, which is sort of a prerequisite for doing either successfully. The second variable I think is equally interesting, which is, how do I build a source of compounding competitive advantage? Like, what are my moats? Right? If I think about Andreessen Horowitz or the firm as a company, as I would as an entrepreneur, entrepreneurs spend all their time thinking about their competitive advantages. And most fund managers, I would argue, don't. Most fund managers are focused, through a fairly narrow lens of like, what is my next marginal investment going to be? Not so much about how am I building a source of compounding advantage. And through that distinction, I think most firms are run by entrepreneurs. I think if you had Marc and Ben on this podcast and you asked them, are you an entrepreneur or you're an investor? They would 100% say we are entrepreneurs who happen to be building an investment management business, right? And, I think that informs ultimately, how we think about, running this business and compounding those competitive advantages, which is ultimately like, how do we build the best product, for founders? Right. We are compounding our reputation first and foremost, but it's only because we're delivering a great product for the best entrepreneurs. And it's been fun. I mean, venture has its own sort of unique history. The source of compounding advantage has largely been brand and reputation, which is paramount. But I think if you broaden the aperture and look at other styles of investment management, those sources of compounding advantage vary wildly. Whether, my first boss had started an amazing investment firm called Royalty Pharma. They became the largest buyers of pharmaceutical royalties in the world. He sort of invented the asset class in the mid-90s. And that's a business, it's now a publicly traded company, with a $25 billion market cap with 50 employees. Like, why does that happen? How does that happen? And it's because it was a permanent capital vehicle. It wasn't a fund. It was a complicated target asset. They built economies of scale. They had lower cost of capital because you could pool these, cash flowing, royalties into a single entity. I mean, I could go on and on, but I think just as a student of sort of investment management firms, it's not to say we want to be them, but I think there's a lot to learn. I always say opportunities live between fields of expertise, right? And I love living in the gray, right? And I view that both as a metaphor for my own career. It's like, am I an entrepreneur? Am I an investor? And am I an operator? Am I West Coast? Am I New York City? Am I Silicon Valley or Wall Street? I think the answer is just be yes, right? And I love kind of that liminal space.
When I look at all of these new funds cropping up and how venture firms describe themselves, they kind of all do the same thing. And you mentioned a great piece, a great part of your piece, which was, around these kind of VC platform teams. Essentially, it's just recruiting a marketer, right? And it's normally just one of each. And they're only catering for maybe 100, 400 companies. When you get to Andreessen size, I think you have something like 400 people working just on the platform side.
Yeah. I mean, we invest hundreds of millions of dollars a year, in this platform, not because it sounds cool, but because it actually moves the needle for the entrepreneurs. And when it does, given the outcomes, that we can, try to help affect, it pays for itself, many, many times over. Right. And I think that's just one of the, kind of unique advantages that I credit all to Marc and Ben for having that foresight early on and thinking very long term. I think many investment firms scale. But by the way, the thing that is so important about building a source of compounding advantage is that I believe funds get more fragile with scale, right? And so if you want to grow, you need to build a source of compounding advantage. You get stronger with scale, right? Everything we do should ultimately reinforce, again, delivering the best product for the entrepreneur, right? And again, instead of paying themselves a lot of money or having, we reinvest those back into the firm, ultimately for the benefit of our founders, and that's paid for itself, again, many, many times over.
I love that, and all of these, or at least some of the new funds which are cropping up, which have a kind of like this moat, a lot of them are focusing on distribution now. So media channels, you guys obviously do a great job of this. Storytelling is kind of like the next big thing. So if any, venture funds listening and they're trying to figure out kind of that moat, is storytelling a big part of it? I feel like there are so many different modes and, channels that these VCs can go down. But a lot of these funds also only have allocated funds available, right? That they can actually invest. Not many are the size of Andreessen. So where do you think they should be focusing? And, where are some of the biggest opportunities you think are available for established or incoming funds to focus on their new mode?
What's interesting, I like Marc, one of Marc's sort of distillations of like what founders want from their VC, he basically described it as power. He's like, when you're a fledgling, young, small company, you don't have the credibility necessarily to get in front of, the Fortune 100 or to attract the best, executive to your business or to have a dialogue with, a key regulator in DC, and it doesn't make sense necessarily for any individual company to invest, the resources in their individual business, to go do that until maybe they're at much, much larger scale. But as a firm, again, we can make that investment and sort of amortize it across, all, several hundred, companies that we work with. And so that's one of the things that I think we lend our power, to our founders, right? To again, kind of tilt their board in their favor. Look, I think there's still a ton of white space, for building, new investment firms. I don't argue that Andreessen Horowitz is the last firm that will ever exist. I think we'll be hopefully successful over the long term, obviously. But I'm good friends, for example, with Patrick O'Shaughnessy, and I think what he is doing, what you're doing, what Harry Stebbings has been doing, building, a media presence, is a source of compounding advantage, right? The bigger their audience becomes, the bigger their platform becomes, the kind of more unique access they get, to the best founders, and they can affect those outcomes on the companies that they invest in, again, given their distribution. And so, again, I think there's a lot of different ways to approach this business, but my aesthetic is one that, starts kind of from an entrepreneurial perspective, more than it is purely from a capital perspective.
It's super interesting. The way we also think about this is, we do a tiny bit of investing just off our own balance sheets and into YC companies. And we say, look, super transparently, we don't write the same check sizes like you guys or other funds. But what we can do is we can be your biggest supporter. We get like 1 million views a month across our channel and we'll give you a very small check. And that's our kind of entry in. We have one of the biggest operators network. So anyone who works at like the top 500 companies, again, we can put them in front of them. And we're tiny, right? We didn't even have a fund. Like this is just us investing off our balance sheet. And, I think those small things can actually make a massive impact. But not many VCs are doing this. Why do you think this is the case?
I don't have a good answer, to be honest. I remember thinking...
It's strange, isn't it?
Yeah, my pitch as an angel, because I didn't have a big, balance sheet either, running a small startup, was to try to be the most valuable investor per dollar of invested capital. I still think we should hold ourselves to that same, kind of threshold, even with bigger checks. And so, I don't know. I think the market has become a lot more competitive. The markets have grown, massively. I think specialization matters more than ever, because the depth of these markets and the complexity of these markets are real. So to be an expert in everything is, I think, quite challenging. But having, a unique point of view, maybe a non-consensus opinion on a given market, a unique network, either with talent or with incumbents to kind of affect, the outcomes of these businesses. I think all of those are still very open opportunities for people to go prosecute.
It kind of feels, this has all changed really in the last few years, right? Especially as storytelling now for founders, is the next big thing they're focusing on. Distribution is becoming more and more important with some of these AI companies reaching, $100 million in their first few years in annual recurring revenue. That also makes me think, what does that mean for like growth funds kind of like down the line? If you're not in kind of like the Ivy League of investors, what does that mean for like the growth investors? I think it's a really exciting space. But I think what's also really exciting is all of these solo GPs kind of like coming through the ecosystem. And I'd like to get your take, so many are coming out, they're focusing on very, particular niches, or they are the go-to, experts in that category. Do you think there's a massive opportunity for solo GPs in this kind of like new venture space?
I do. Look, I think so long as you have kind of a differentiated, point of view, right, or differentiated strategy, I think there's still, plenty of opportunity, especially at the early stage, right? The market is still not perfectly efficient, right? And we were looking at this recently where I forget the exact statistic that we were tracking, but it was basically like, what was the consistency of the seed investors into companies that became successful? I forget if it was like they had raised a Series B or if they hit some valuation milestone. And there was only one seed firm that showed up twice out of a landscape of, I think, 70 companies that we were tracking, right? So it isn't that like there's some seed fund that is capturing all of the best companies at that stage. It's actually pretty distributed, right? And so again, if you have, I think, a unique, unique access to a given talent pool, unique perspective on a market, you're early and right. I think that opportunity still definitely exists to build a firm, over time, and you can kind of use that early success to compound. At the same time, many people don't aspire to build firms; they want to run funds, and I think that's okay too. I think it's more about understanding what game you're playing and playing it, incredibly well. I think that the challenge, and this is not that novel of a take anymore, is that you have kind of, focused specialists, either by sector or by stage, at one end, and then you have large-scale kind of platform firms. I think the challenge is largely in the middle, where it's a $300-400 million fund of generalists. The brand doesn't necessarily stand for anything. Check sizes have increased. They don't have a platform team. Like, I think those become quite challenging, right? You have some that will succeed, because of their brand legacy, but I think many are going to find it, very difficult.
Is pretty incredible, just where this, where kind of the venture's going, firm versus fund, but also just the size of your platform team. 400 people, in comparison to other funds, this is a magnitude of, much bigger. Is that, do you think, what sets Andreessen apart going forward?
I think it's one of those things. Again, we everything that we do is, again, oriented around how do we deliver the best product to founders, right? And most of us were founders ourselves. So it's funny, one of the ways that many other firms or funds maybe try to counterposition against us is they say, Andreessen is this huge firm. The operating platform is really just a way to scale the GP so that I can work with more founders, right? And I think it's kind of a bullshit argument, candidly. It's because it's not one or the other, right? By the way, many of the people that say that were never entrepreneurs themselves. They've been investors their whole career. Having been an entrepreneur, I'm often jealous of the founders that we get to work with because they have this wealth of resources that would have saved me so much time and effort. But the reality is you get all of my time and expertise and, hard-earned wisdom and learnings, and you get 400 people behind me, that can kind of tilt the board in your favor. And I think I say that with humility because I'm not going to have every answer, right? I will help the founders that I work with avoid all the mistakes that I made. But the reality is we have, people that are far deeper specialists, who have run 1,000-person companies in HR and done riffs. How do you communicate a riff in a big company? What is the HR policy? What is the communication language that you should be using? These are things tactically that can make or break a company. I'm not going to have that experience, but Don on our people practices team does, right? And so again, my job is both to kind of lend my own individual experience, but marshal the resources of the firm to make our founders as successful as we possibly can, right? And so I think that the distinction is sort of a false equivalence. It's why wouldn't you want every advantage you could possibly get to be as successful as possible? And that's our point of view.
It's incredible. You've mentioned Marc and Ben a few times, obviously one of the greatest founders out there. What's the greatest lesson you've learned from them?
A lot. There's two things that have been particularly interesting to me since I joined. One is just how deeply involved they are in everything. They are running the firm, right? Ben, from my observation, is our CEO, and Marc is sort of the chairman and chief strategist. But they are in every, partner meeting, in any pitch meeting you need them to be. And I think that's just so rare, right? In many places that I've worked, people hit some level of, material success. And they are literally or metaphorically on a beach. And I was often the young kid, pulling the firm to be more, aggressive or more ambitious. And that's just not the case here, right? The intensity, the focus, the drive, starts with them and flows sort of top down. And I feed off of that intensity, right? I think we all do. I think it's one of the core reasons the firm has been so successful. The other thing which was surprising to me and I didn't fully anticipate, and I think this is actually a core distinction in many ways between funds and firms, is that despite it saying Andreessen Horowitz on the door, there's actually very little top-down direction, right? They've done a remarkable job making the firm feel like a platform for smart entrepreneurial people to build on top of. And I think that's a really thoughtful and wise thing to have done, both to attract and retain the types of folks that they have been able to, right? If you think about, people like Chris Dixon or Alex Rampell or Martin Casado or, David Ulevich, all of these folks were incredibly successful entrepreneurs before they got to Andreessen Horowitz, right? They didn't have to work, candidly. They can kind of do whatever they wanted. And again, they're entrepreneurs. They don't want to be micromanaged. What they want is to be given, the biggest canvas, the nicest paint and paintbrushes, and told to go paint their masterpiece. And I think the firm at its best is that, right? It's sort of delegated conviction, right? And kind of group tackle, And so while Ben is the CEO, he's not the CIO, right? Each of the folks that I mentioned run, our own kind of respective, platforms, which you can kind of think about almost like divisions of a company. If Martin or Chris had to get every single deal approved by Marc or Ben, they would never work here. But that's not how most of our competitors operate. Most funds, especially hedge funds, but which is kind of the extreme version, I would argue, of funds, they often have a single CIO. It's the alpha, kind of investment decision maker that, they have a bunch of other people that work at the firm, but ultimately it bubbles up to one person making a decision. And obviously that can work. You can make a lot of money and be very successful doing that. But I think it's very fragile, right? It's very fragile. If that person decides to retire, or God forbid something happens to them, the entire infrastructure, competitive advantage of that firm disappears almost overnight. And so I think the sort of delegated authority, the decentralized decision-making, I think time will tell, but I think is one of the most important reasons the firm, I think, is going to be, so enduring.
I love that. This whole decentralized model, I think, it's pretty unique, I think, in venture. Not many people do it. But also, if you look at all the amazing products you guys have, kind of like outside of the A16Z core, okay, you have your funds, you have Speedrun, you have A16Z media fellowships, you have Tech Week. I'm doing the selling, right? I mean, there's probably a whole bunch more, but you're building these like mini products that can, filter into, I guess, the A16Z ecosystem at some stage.
Totally. I mean, even Eric Torberg and I, had been friends for almost 10 years, before he joined the firm. I was an angel in On Deck, and we've just known each other a lot kind of through the ecosystem. I think what he's done with the new media team is a great example of this. Like, he's an entrepreneur, first and foremost, and they've given him a lot of freedom and resources and rope, again, to go kind of like be creative, be entrepreneurial, build an amazing organization. And you're already beginning to feel, kind of the significant impact that team is having, both in our portfolio and I think in the market. But it's because of that sort of freedom, that I think, you can attract somebody like that and help make them successful.
Exactly. I think it's so exciting, but also, yes, it's also so unique. And I was also, I had the lucky privilege of attending Speedrun Demo Day last year in SF. That was like super cool. And again, going back to Eric and kind of the new media team, you guys kind of hosted a dinner for some of the biggest creators. And I think that's, talking about kind of bringing this full circle, the fund versus firm. If you want to build an amazing, firm that creates all these amazing products and has an everlasting kind of, unique advantage and, horizon for founders, this is the way to do it.
I appreciate you saying that. We think so.
Maybe segueing into some of the trends you're really excited about. I think this is always the most exciting part of the show. As we mentioned earlier, AI is changing absolutely everything from fintech, these kind of like boring industries that we used to think there's no innovation or no opportunity available, but actually now there is, right? But also I think there's a new trend kind of like emerging where instead of, all these AI companies going straight into these, potential customers, selling them the product, they're now actually showcasing what the impact of that product can be and the types of decisions they can make which makes the product better and hopefully, increases their revenue and so on. I think that there are so many trends we can talk about, but maybe, one in particular is around fintech, right? Which I know is your kind of area of expertise and kind of background. When you look at the whole kind of financial services ecosystem, where do you think the biggest opportunity right now is for founders to build an AI or reimagine what financial services looks like in the next 5 or 10 years?
I think there's a lot. I mean, I think, financial services is one of the most human capital intensive industries, right? You have lots of highly paid people, living largely in Excel, right? Not even using Excel as a modeling tool, but often using Excel to kind of track work. And again, I think the kind of most fundamental paradigm shift that's happening with AI is like the software itself can actually do work. And so I think we're still at the bottom of the first inning in terms of how this technology is just going to change the way that all of these large incumbent companies operate. I'll give you one example, a company in our portfolio that's doing quite well. It's a company called Salient, right? They started with voice agents doing loan servicing. They started originally in auto lending, but they've expanded now to kind of a whole ecosystem of consumer lending products. And so the voice agent will do welcome calls, payment reminders, and actually do collections. And again, the product can speak in 50 languages, fully compliantly, is infinitely patient, works 24/7. And it's not just a cost reduction story, right? Many of these large banks or large non-bank lenders have 1,000+ person call centers. Obviously, there's a cost efficiency story there, right? In having the software do the work, But what is most remarkable to me is they're actually finding that that Salient is actually getting 50% better collection rates, right? So in many cases, it's actually delivering a better product and driving revenue. And that's one of the kind of core things that I think we look for in the types of AI companies that we're looking to back is that are having an impact on both sides, right? There is a cost reduction element, but it's actually changing the fundamental economics of these businesses, often by driving, meaningful revenue. And again, I think that's just one, small example of how, many of these large financial institutions operate. And I think the culture of these firms are changing. I saw this certainly within Goldman Sachs. I think there's now a willingness, to adopt third-party technology faster, than it ever, happened previously. That's often been the knock of selling into kind of, big finance, is that they move very slowly. And I think AI is just, this wave is going to happen and is shifting much faster than any prior technology cycle. Because, if you were the CEO of Goldman or any large financial institution, you were asking yourself, 10 years ago, like, do I need to be in the cloud? It was kind of an esoteric question, right? It was hard to draw an immediate through line to the kind of commercial outcome. Now, there's both bottoms up momentum, right? You're seeing, the engineering organizations, adopt products like Cursor that are driving massive productivity gains. You're seeing, the customer support organizations adopt products like Decagon and driving massive efficiency gains, with call deflection. But likewise, like every CEO, every board member, technical or not, any of these companies can now plug a prompt into one of these models and immediately sort of intuit the impact that the technology could have on their business. And so I think there's just also this sort of top-down pressure and momentum that is happening. I mean, AI is a topic of every single board conversation at every incumbent that we talk to. And I think those that sort of embrace this technology, again, have an opportunity to kind of radically transform, their own fundamental economics in the way that these businesses run. And again, we're still at the very early innings of that, but it's such a huge opportunity. Financial services is a massive part of our global economy. So I've never been more excited about opportunities in fintech than I am today.
And what's amazing about this whole AI space now is like anyone can actually build a product. They don't need to know how to code or build products. They can go to Lovable, they can go to Cursor and just start building it, right? I was just speaking at this conference in Dubai called the 1 Billion Follow Summit. It's basically like the biggest creator summit where all the biggest creators go. And my talk was around, is AI the breakthrough for creators? There are millions of creators out there. Creators can just go and build, products for the audience and start making millions of dollars. That never happened 1,000 days ago. If you were to start a company today, what would you start if AI was to change in the next 1,000 days?
That's a hard question. I mean, probably something along the lines of what I just described, right? I still think that there is, again, I saw this at Goldman, and Goldman is one of the most progressive and kind of tech-forward large financial institutions. They had 10,000 engineers. And yet, so much of that firm, wasn't using AI, let alone enterprise software. That's changing, obviously, very quickly, let alone large insurance company in the Midwest or, pick your kind of financial institution. So, yeah, I think it would probably be, building some sort of software product to change, kind of core back office workflows of some of these large financial institutions. Maybe not the most sexy thing to begin with, but I think given, the kind of relationships and the impact that this technology can have, that's probably, just off the top of my head where I'd probably, start.
Yeah. Okay. And another question, if we look forward in the next 1,000 days, where's AI going to be?
Oh man, it's hard to predict, what's going to happen next month, let alone in 3 years. I don't know. I mean, I suspect it's going to be, much deeper penetrated into most large enterprises. Not just, today I would argue, again, like the three areas that have probably the most product market fit for AI are, anything code gen, customer support and legal, just given how document intensive it is. But that's just the tip of the iceberg. And so I think you're going to see AI, you can go far deeper into these organizations, across compliance and operations and, treasury management. And so I think you're just going to see the sort of, much deeper impact in driving efficiency and automation across these companies. I think you're also going to shift from, AI being, a co-pilot and augmenting, humans to do their work and shifting, into becoming kind of a management layer, humans being the manager of kind of a bunch of AI agents, who are going off and actually doing, work throughout the enterprise. And, and I think you'll see the product sort of more deeply integrate into the kind of very siloed systems of record and understand context across an organization. I think you'll see companies begin to gather different types of information, a lot of unstructured information, like this conversation historically was never documented by, legacy software. And actually that's like the context and color, for a lot of how decisions get made inside of a business that historically lives in people's heads. And so if you can actually put that into code, right, you can make a lot more decisions in a more automated fashion than you have been able to previously. And so I think, gathering a lot more unstructured information, voice being obviously a very important and kind of primary input of that. I think most conversations inside of companies will be recorded because that context and kind of connective tissue is so important for giving, agents autonomy to go actually do work and make decisions in big companies.
It's super exciting. It's so hard to keep up. Even for us, we cover all of the AI trends, but it just keeps changing every single day. But I think we can both agree, hopefully, that AI is here to stay, and what the future venture looks like is going to be super exciting, and hopefully more funds focus on becoming a firm versus a fund. Amazing. Thank you so much for your time, David. This has been so cool. Where can founders find out more about you? Where can founders get connected?
Well, yeah, thank you again so much for having me. Obviously, you can visit all of us at A16Z.com. You can find me on Twitter at dhaber. Would love to hear from folks building firms and from entrepreneurs building the future.
Amazing. Go and follow David on X. So many great forwards, and thank you so much again. This has been amazing.